Here's a unique angle from insightfulvalue.com. Yes, we're zooming in on Smurfit Westrock because its share price is under pressure, and that could signal an undervalued opportunity or a caution flag. This review is for informational and educational purposes only, not financial advice. If you're into these kinds of breakdowns, hit subscribe, like the video, and drop your thoughts in the comments. Smurfit Westrock is a global packaging and paper-based products company born from the merger of European-based Smurfit Kappa and US-based Westrock. Operating in approximately 40-plus countries and offering corrugated packaging, containerboard, recycling operations, and forest-sourced raw materials. From a value analysis perspective, you get scale, global reach, a large asset base, and exposure to structural packaging demand, growth of e-commerce, sustainability-driven packaging shifts. But you also face margin pressures, integration risk, commodity cost exposures, and volatile end markets. Recent updates. In the second quarter ended June 30, 2025, Smurfit Westrock reported net sales of $7,940 million, an adjusted EBITDA of $1,213 million, giving a margin of about 15.3%. However, the company posted a net loss of $26 million for the quarter, minus 0.3% net margin, after restructuring and closure costs of approximately $280 million. For the first quarter, it posted net income of $382 million, margin about 5.0%, and adjusted EBITDA margin about 16.4%. The board approved a quarterly dividend of $0.4308 per share. Why is the stock down now? Investors are concerned about near-term profitability, net loss in Q2, margin compression, cost inflation for raw materials and energy, regulatory/operational risks in global footprint, and the hangover from large integration and merger-related expenses. Additionally, earnings have been declining over recent years, even as revenues grow, suggesting pressure at the bottom line. What are the chances of recovery? On the upside, if Smurfit Westrock can hit its synergy targets, note they targeted $350 to $400 million in synergies this year, improve operational efficiency, benefit from structural demand in sustainable packaging, and if commodity/pricing dynamics improve, then margin expansion and earnings growth could follow. On the downside, if cost pressures persist, global demand weakens, or integration costs exceed expectations, the low price may simply reflect deeper structural issues. Why might one consider investing now? If you believe packaging demand remains strong, e-commerce growth accelerates, sustainability trends favor paper-based packaging, and Smurfit Westrock's global scale gives it leverage to improve margins, why might you hold off? If you prefer companies with clear and consistent profitability, less cyclicality, and fewer integration risks, then waiting for clearer evidence of turnaround might be wise. In summary, Smurfit Westrock presents a compelling story of scale and structural tailwinds, but the current headwinds are real and visible in the numbers. For deeper dives on this company and many others, you can visit insightfulvalue.com. We dig into the metrics, explain the numbers clearly, and help you uncover potential undervalued companies without the jargon. Thanks for watching. Remember to subscribe to our channel, like the video, and leave your thoughts in the comments. Visit insightfulvalue.com for more.